Hello and welcome back, and this is inventory part 3. We're going to go through an example of purchasing inventory in terms of the journal entries and then the various different T accounts. So the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Any company names or references to publicly traded companies or well-known privately held companies that are used in these presentations are the trademarks and/or copyrights of those respective companies. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So the one we're going to look at right now is we're going to look at this comprehensive problem in terms of for purchasing inventory. I'm just going to do this on a Google Sheet, but this is to really give us an example in terms of what happens on the purchasing side of things. So right over here, let's go ahead and go over to this link. So right over here, we're an electronics retailer, and we're doing this from the perspective of MAI. So on April 1st, okay, MAI purchases 1,000 refurbished phones from $30 each from Cell Phones Refurbished Inc. on account. The terms are 210 net 30 FOB shipping point. The phones originally cost CRI $7 each. So we don't really care what the phones cost CRI. Rather, we're more concerned in terms of what we're spending essentially for these phones. Okay, so right over here. Okay, let's get rid of this part here. So, okay, breaking every YouTube rule one day at a time. Okay, so as I look at this right here, so let's see what we're going to do on April 1st. So I bought 1,000 phones. So basically I purchased 1,000 phones for cost per phone. So I bought 1,000 phones at $30 per phone. So, and right over here. So on April 1st, I bought 1,000 refurbished phones for $30 each on account. So when I see on account, it means I'm not paying for them in cash. Rather, it's going to be accounts payable. The terms are 210 net 30 FOB shipping point, and the phones originally cost CRI $7 each. So the key here is if it's FOB shipping point and those were shipped on that day, then that's when I'm going to go through and record the transaction. So right over here, the amount I'm going to be recording on April 1st is going to be 1,000 times 30, or a total of $30,000. So here on April 4th, I'm debiting inventory for $30,000. And for every debit, I need a credit. And my credit is going to be right over here to accounts payable over here for $30,000. And this is going to be on April 1st. Okay, so right over here. And does this make sense from our T theory of accounting? Well, if I look at my T theory of accounting, and this kind of, remember going back to basics here, I've got my assets equals my liabilities plus my owner's equity. And when I'm looking at this right here, when I'm recording transactions on T accounts, B, C, E, R. So I'm showing an increase to an asset with a debit, and I'm receiving inventory. So I'm debiting my inventory. And then I'm showing an increase to my liabilities because I have not yet paid for that inventory. So if I'm doing a journal entry, over here on April 1st, I'm debiting inventory for $30,000. And then I'm going to credit And notice over here for crediting accounts payable, I have to indent my credit, especially the account description. Okay, when I grade exams, this is a very common thing which I take points off of for. So last thing I need is I need a description to record purchase of inventory on account. Okay, so second one right here is right over here. The terms are 210, so I've done that one. I received the phones. Now, if this would have been FOB destination, then I would not have recorded this on April 1st. In fact, I would have done nothing. If I received the phones and if it was FOB destination, I would have recorded it on April 2nd. So here, the receiving the phones doesn't matter. It's when they were shipped, okay? So I received the phones and I paid $100 for shipping costs. So when we look at this right here, and one of the costs of our inventory is going to be our shipping costs. If we're paying money to have the goods shipped to us, we include that cost in our inventory. So I'm going to be here debiting the inventory here on April 2nd for the $100. And I'm going to be crediting cash over here for the $100 because I'm paying cash for those shipping costs. So over here to do this as a journal entry on April 2nd, I'm going to debit the inventory. This is going to be for the shipping costs. Because remember, what gets included in the cost of my inventory are my purchases, plus any kind of customs or tariffs, plus kind of any shipping costs. Okay, and then I'm crediting cash for here for $100. And then here is to record shipping costs from 4/1 purchase. Okay, so we're going to keep going. That's April 2nd. On April 3rd, I return 50 cell phones to CRI that are found to be defective, and I receive full credit. Okay, so if I'm returning cell phones right over here on April 3rd. So on April 3rd, I'm returning 50 cell phones. So my quantity return is going to be 50. The cost per phone, or my cost per phone, was $30 each. So the amount of my return is going to be $1,500. And note here, I do not need to give you that $1,500 amount if I'm showing you what I paid for the amount for the phone. Now note here, this is meant to deceive you because the phones cost CRI $7 each, but they're charging us $30 each. So that's why I'm using over here this $30 per phone. So when I'm returning these items, when I'm doing a return, I no longer hold that inventory. So what I'm going to do over here is on April 3rd, I'm going to be crediting my inventory for $1,500. And then what I'm going to be doing over here is I'm going to be crediting accounts payable for $1,500. And why am I doing that? It's because at this point in time, once I return something, do I still owe them $30,000? And the answer is no. It's going to be $30,000 less than $1,500. So to do this one as a journal entry over here on April 3rd, I'm going to be debiting accounts payable. Okay, I'm going to be crediting inventory for $1,500. Okay, so I'm debiting accounts payable. I credit inventory for $1,500, and this is going to be to record the inventory return. Notice really here, and this is why you need to be practicing at home, you have to indent your journal entries. I cannot tell you the importance of doing this. Very, very critical. Okay, so let's go to our next one right here. So that's April 3rd. On April 4th, we receive a $300 purchase allowance for being a great customer. So right over here, when I'm receiving a purchase allowance, essentially like what's happening at this point? Well, when I'm receiving a purchase allowance, okay, basically what that means is that's going to reduce my inventory cost because I no longer have to pay this. So what I'm going to do is I'm going to credit inventory for 300, and I'm going to also credit accounts payable for 300, and this is going to be on April 4th. So over here on April 4th. So again, this is how I record it into the T accounts, right? That's what a purchase allowance is. The seller is telling me, hey, Tchaikovsky, or hey, MAI, you no longer have to pay $300. You're a great customer. You know, we want to give you less hassles. So right over here on this purchase allowance, and this is going to be on April 4th. So essentially going to be the same transaction as above. I'm debiting accounts payable. I'm going to be crediting inventory, and this is going to be here for 300 to record purchase allowance. Okay. Very important is when we're doing this, when we do this from the seller's perspective a little bit later, it's going to be totally different. And we're going to handle each of these transactions very, very differently. And we'll go through the reasoning why we do that for on the sales side. Okay. So over here, I find 20 defective cell phones, and instead of shipping the goods back to CRI, they give us a purchase allowance of $600. Okay, so I find another 20 defective phones, and instead of shipping the goods back to CRI, they're giving me a purchase allowance here of $600. So same thing as above. What I'm going to do right over here is I'm going to say, okay, I've got 600. Credit to inventory for the amount of the purchase allowance. And then over here, this is going to be on 4545. And so again, I'm just kind of doing the same thing. Over here, I'm going to be debiting. I'm debiting accounts payable. I'm crediting inventory for the amount of the purchase allowance that was given to me for those defective items that I found. Okay. So to record purchase allowance for 30 defective, or for the 20 defective phones. And if you want to just kind of see how they got to this amount for the defective phones, or why it's $600, so right over here, you would say over here, April defective was 20 phones. The cost per phone was 30. So my total allowance here was going to be the 20 times the 30, or the 600. That's how they came up with that amount. Okay. So I get to April 10th, and they're now paying the balance due on the cell phones. Okay. So before we get to this, the first thing we have to figure out is, are we going to be entitled to take a discount? Well, if the terms are 210 net 30, am I paying within 10 days? And the answer is yes. So I'm going to be eligible to take a discount. So what we first need to figure out is, how much do we actually owe? Okay, the answer is not $30,000, okay? The answer over here is going to be, initially I did owe $30,000. However, with the returns and the like that we've had going on, the actual amount that I do owe now is going to be, it's going to be 30,000 less 2,400, or 27,600. That is the amount that I owe. Okay, so again, 30,000 was the initial amount, less the 1,500 for the physical return, 300 for the purchase allowance, and another $600 purchase allowance. So the amount I owe is $27,600. Because I'm paying on April 10th, and that's within 10 days of the transaction, the amount that I'm going to be paying is going to be, so the amount due is going to be $27,600. My discount amount is going to be 2%. So the total cash discount is going to be $27,600 times 2% or $552. So my total cash paid is going to be the amount due, $27,600, less the cash discount. My cash discount here was $552. So my total cash paid is going to be $27,048. So if I do this as a journal entry, right? So if I'm paying for my inventory in cash, my cash is decreasing. So over here, I'm going to be crediting cash for $27,048. Okay. So here, I'm going to go up to my cash, and I'm going to credit this over here for $27,048. Okay, this is going to be on April 10th. All right, so that's on April 10th. So I'm crediting cash for $27,048. Once I pay the discount, or basically once I pay this, and if I'm paying within the discount period, do I still owe anything to the company, right? So if I credited cash and I debited accounts payable for that same amount, right? Say for instance, I went over here, right? And I credited this here. The problem I would run into is I would still have a balance of 552, which is not right. So when I'm dealing with a discount, and if I'm taking it properly within that time period, what I'm going to be doing is I'm going to be debiting accounts payable for the entire thing. So when I debit accounts payable for the entire amount, right, my balance in accounts payable now needs to be 0, which it is right here. Okay, so I'm going to highlight these so we can kind of see that they're all from the same transaction. Okay, so because I'm taking advantage of the discount here on April 10th, right? I'm going to get rid of this entire thing because the vendor says, hey, if you pay me within this time period, you can take a discount and you don't owe me anything. So right over here, I'm going to be debiting accounts payable for, or decreasing my liability here for a total of $27,000. Okay. Or say, sorry, it's 27,600, right? 27,600. There we go, 27,600. Sorry. Okay, so this is on April 10th. Okay. Now, the last thing as my problem is here, my transaction does not balance. Okay, so I've got this $552. What does this have to go to? This is going to be going to inventory. And if you go back and look at this presentation, and especially the earlier one where I went through in terms of the T accounts, and in the T accounts in terms of what increased and what decreased my inventory, okay? Purchase discounts, purchase returns, and purchase allowances, right? Those decrease. And so what I'm going to be doing here is I'm going to be showing a credit to inventory for $552 on April 10th. So that's how I go through and record this. So the ending carrying value So again, this is how I'm going through and doing my journal entry, right? This is why it's so important that you know how to go kind of do both the journal entry and the T accounts, because we got to make sure we're balancing these. Our total debits have to equal our total credits. So when I go through here and I finish adding these up, the ending balance in my inventory account is going to be let's see here. $27,148. Okay. Now, if you're looking at this, you might be saying to yourself, well, wait a second, why is this higher than the cash that I paid out? And it's because I had to go through and capitalize my freight in or those costs into my inventory. That's why it's different than the cash being paid out. So again, when we're dealing with from a purchaser's perspective, right, it's a little bit more simple. When we go do this from the seller's perspective, it's going to be a little bit more complicated. And the reason being is because we're going to actually be showing, we've got to do two different transactions for the purchase, or something for the sale. When we have goods coming back, that involves two different T accounts, and et cetera, et cetera. So I want to thank you for joining me here today for this video. Please don't forget to like and subscribe. And I will see you on the next video, which will be going through and doing, which will be part 4, which is going to be going through and looking at the typical journal entries we use when we're actually going through and recording sales transactions. Have a great one, and I will see you on the next video. Take care. Bye-bye.